let's just set the scene. The jitters, as Brady was saying, all too apparent, given the Fed chairman and then the minutes kind of acting to confuse, a big sell order hitting the markets. How do we react?
Yeah, like some mixed decision in the markets overnight. We saw initially the markets moving higher. Bernanke's prepared statements continued to be pretty dovish and in line with what we'd been hearing from the Fed in recent months. But then in the question and answer session later in the day, we saw his comments turn a little bit more hawkish. And I think some of the key comments we heard were the fact that they're going to be reviewing over the next few months over the meetings in terms of tapering off QE. And really that puts the onus now back on the US data that will be released over the next few months, in particular labour force data, of course, but also inflation. And I think the markets somewhat should be expecting that we're going to start seeing some of these comments. I think the concerns in the market is about when we're going to start seeing this tapering off and how quickly the quantitative easing is removed from the market. But I think in a general market sense, the market knows that quantitative easing is going to be removed, so I don't think we need to worry about it in that sense too much. And I don't think it's going to be a repeat of what we've seen sometimes in history when quantitative easing has been removed from the market. I think the market needs to remember that when the Fed does taper off this easing, it's because the US economy is improving significantly. The labour force has improved significantly, and in general this should be a positive for the market. It's a positive for corporate earnings and a positive for the market and economy in general. But we also know that the pace, there's no real urgency for the Fed to remove the stimulus at any rapid pace either. If we look at inflation at the moment, it remains well contained in the US and probably pretty well contained globally, and expectations for inflation in the US is probably to continue to be pretty well contained. So there's no real need for them to remove this stimulus with any great pace either. And I think another point that we need to remember is the Fed will be communicating with the market quite well about how they're going to be removing this. So we will start seeing comments flowing through from the Fed before they start removing the stimulus. So I think the expectations in the market now are we're probably going to be seeing some tapering off of this stimulus towards the end of 2013. But we can also remember that interest rates in the US are still probably going to remain at zero through 2015 through 2016. So again, I think over the next few months, the US data is going to be key.
Just in terms of James Hardie, then obviously, you know, with 2/3 of its earnings coming from the US and Europe, what's your thinking then on this? I mean, we've had the full year results out. Obviously, it's one you just need to be careful of given what we saw in the previous year there. But the special dividend and what they've been saying about the US, what did you make of that?
Look, James Hardie, there's really two big key drivers of James Hardie, and I think the market has really recognised this over the past year, and that's why we've seen such a big performance in James Hardie's share price. Of course, on one side, they're leveraged towards the US and the US housing market, and this has continued to be particularly strong. It's really added to the US recovery, probably the main driver of what we've seen in the US in terms of the economic recovery, and that's really benefited James Hardie's share price. But again, over the past couple of months, we've seen the share price continue to strengthen, even though there has been some calls that, you know, it's run up a little bit too fast and it's looking pretty fully valued at the moment. But now we've seen the Aussie dollar come off as well. So this is the second big benefit for James Hardie share price and earnings, is when this Aussie dollar moves lower, it's going to be a big benefit for those offshore earnings, as you mentioned, through Europe and particularly the US that it imports back here to Australia. So I think what we heard from them this morning, I didn't get a great chance to look at it, but special dividend, we know the market's obsession with dividends at the moment, so that's going to be accepted with open arms from the market. They also came out with some comments that they are quite optimistic around the continuation in terms of the US housing market. So I think positives for James Hardie. Really, it's those macro drivers that have been driving the share price, because the previous quarter performance was a little bit disappointing. We saw the miss expectations in the market, but it looks like these results came in pretty in line with what the market was expecting, with a bonus of a special dividend.
We're just seeing shares, they've opened up about 2% stronger, just paring those back slightly now in the first few minutes of trade, just up about 1.25%. They're around that $10.58 mark, Tim?
Yeah, so opened higher. Yeah, that's probably what we're expecting in terms of a special dividend announcement. We've seen announcements of special dividends from other companies in the market recently. Woodside share price reacted very well to its announcement of a special dividend and an increase of its payout ratio. One of the big banks we saw come out with special dividends. So yeah, the market really liking this from James Hardie. It's got to be earning some significantly good earnings from its US business at the moment. So if the Aussie dollar can continue to fall, the US housing market continue to improve, then it looks like their dividend payouts will be quite stable.
Let's talk, shall we, QBE, because we've got a slew of broker upgrades this morning, and meanwhile we get a rotation call away from Wesfarmers, from Bell Potter's Charlie Aitken, into the stock. What do you make of the timing?
Look, QBE, again, big beneficiary of a lower Aussie dollar, but also a big beneficiary of a higher US Treasury bond yield. And yeah, Bell Potter coming out today, we heard that they're adding QBE to the high conviction list at the expense of Wesfarmers, saying Wesfarmers looking a bit toppy now, dividend yields fallen a bit. So I think QBE will be a beneficiary of the lower Aussie dollar. We know that it invests a very large amount of its premiums into the US Treasury market, so that actually creates a very large correlation between QBE's share price and the US bond yield. I've actually got a chart here that you can see this on. This is a 5-year chart, the black line being QBE, the blue line being the 10-year yield in US Treasuries. You can see the very close correlation between the two there. So I think the calls now is the market's already recognised the fact that the lower Aussie dollar is going to be benefiting QBE. That's why we've seen it put in a good performance. But on the charts, if we look at the US bond yield, which really is a big driver of QBE, it's testing in pretty important levels at the moment. It's back above 2%. It's testing sort of 2.04%, which is a key level for the US bond yield. And if it does break through this level, it could be heading up, looks like on the charts, anywhere up to close to 2.4%. If we saw that happening, we could well see QBE share price push up $16, $17 a share. So I think this is a big positive for QBE, and we've seen a few brokers upgrade both their target prices for the stock price and also their rating recently.